September 2020. JP Morgan pays $920 million, the largest fine in CFTC history. Wire fraud. Spoofing. 8 years of silver manipulation. 2 traders go to prison. The bank admits everything. Case closed, or so it seemed. December 2025, 5 years later. Same bank, same metal. But this time, the story is different. They're holding 750 million ounces of physical silver, the largest private stockpile in human history, worth over $40 billion at current prices. And for every single dollar silver rises, JP Morgan gains $750 million. They flipped from convicted manipulator to the largest private holder, from paying the biggest commodities fine in history to sitting on one of the most profitable positions in modern finance. And every step was documented in public filings. This is the story of one of the most remarkable position reversals in financial history. And by the end of this video, you'll understand exactly what happened, how it was legal, and why it matters. Let's start with what they did, because you need to understand the documented crime to appreciate what came next. From 2008 to 2016, JP Morgan's precious metals desk ran a spoofing operation that the CFTC would later call one of the most extensive manipulation schemes in commodities history. The method was documented in federal court records. Here's how it worked. A JP Morgan trader would place a massive order to buy silver futures, let's say 5,000 contracts. That's 25 million ounces. The market sees this huge buy order appearing on the order book. Other traders react. The price starts to move. And then, before the order executes, JP Morgan cancels it. Gone. According to the CFTC, these were never intended to be filled. They were designed solely to move the market. But here's what the federal investigation revealed. While everyone was reacting to that large order on one side, JP Morgan was quietly trading on the other side, at the prices their fake orders created. The CFTC documented this meticulously. According to their September 2020 order, JP Morgan placed hundreds of thousands of fraudulent orders over 8 years, creating what the commission called false signals of supply and demand that deceived other market participants. The markets affected weren't just silver. Gold was included too. The total penalty? $920.2 million are split between spoofing penalties, disgorgement of illegal profits, and restitution to victims. At the time, it was the largest commodities fraud fine the CFTC had ever levied. 2 men went to federal prison for this. Michael Nowak, who headed JP Morgan's global precious metals desk, received 1 year and 1 day behind bars. Greg Smith, an executive director on the same desk, received 2 years in federal prison. They were convicted in August 2022 and sentenced in August 2023. Real convictions, real prison time. The Department of Justice documented the entire case, but here's where the documented timeline gets interesting. Because while the manipulation was happening from 2008 to 2016, something else was happening simultaneously. And this part is entirely legal and documented in public warehouse receipts. Let me take you back to April 2011. Silver hits $49 per ounce, approaching the Hunt Brothers 1980 high of $50. Retail investors pile in. Industrial demand is rising. Solar panels need silver. Electronics need silver. The supply-demand fundamentals look strong, and then the price collapses. By 2012, silver trades at $27. By 2013, it's at $20. By 2015, it's at $14. For 8 years, from 2012 to 2019, silver trades in a range between $14 and $20 per ounce. And during those exact years, according to COMEX warehouse data that's published weekly, JP Morgan starts accumulating physical silver, not paper contracts, not futures, physical bars delivered to their vaults, documented in public records. In 2012, according to COMEX warehouse reports, JP Morgan held less than 5 million ounces of physical silver. By 2015, warehouse receipts showed 55 million ounces. Seeking Alpha published an article that year titled, "Why is JP Morgan accumulating the biggest stockpile of physical silver in history?" The accumulation was visible in public data. It wasn't hidden. But outside precious metals specialist circles, it wasn't widely discussed. By 2019, according to warehouse data, they held over 150 million ounces. And here's the documented pattern. According to price data from that period, they were accumulating at prices between $14 and $20 per ounce. These were the same years the spoofing was occurring. The same years federal prosecutors would later prove they were manipulating the paper market. Whether this was coordinated strategy or separate opportunistic buying, we can't know from public records. What we can document is the timeline. Manipulation of paper prices happened. Physical accumulation happened. Both occurred simultaneously. Now, let's talk about something else the CFTC publishes. It's called the Bank Participation Report. This report shows the aggregate positions of U.S. banks in commodity futures markets. According to these reports from 2010 through 2019, one or more U.S. banks consistently held massive short positions in silver futures, often exceeding 200 million ounces. Market analysts widely attributed the largest portion of these shorts to JP Morgan, though the CFTC doesn't name individual banks in these reports. Think about this documented pattern. Large paper shorts in the futures market while simultaneously accumulating physical metal. If silver prices rise unexpectedly, the paper shorts provide a hedge. If silver stays suppressed, they continue buying physical at low prices. It's what traders call an asymmetric position, and it's visible in public data if you know where to look. Then, in September 2020, the CFTC announces the $920 million settlement. JP Morgan admits to the spoofing violations. 2 traders eventually go to prison. Justice appears served. But by that point, according to warehouse data, JP Morgan had already accumulated hundreds of millions of ounces of physical silver at prices that would later look like generational lows. And then came 2025. According to National Gold Consultants, citing data from the bank participation reports and COMEX positioning data, something remarkable happened between June and October 2025. JP Morgan closed what sources estimated as a 200 million ounce short position in silver futures. Multiple precious metals analysts reported that this was the first time in over 15 years that JP Morgan appeared to have zero net short exposure to silver. Let me put this in perspective using the numbers. They went from net short approximately 200 million ounces to net long 750 million ounces of physical. That's a position swing of nearly 1 billion ounces. According to the Silver Institute, global annual silver mine production is around 800 million ounces. The position flip was equivalent to more than 1 full year of global mining output. And according to the Times of India, reporting in December 2025 and citing industry sources, JP Morgan added 21 million ounces of physical silver in just 6 weeks between October and early December. That's during a period when silver was already rallying. That's documented accumulation during a price rise, not just during the suppression years. Now let's look at what JP Morgan's research analysts were telling clients. According to reports from early 2025, JP Morgan's commodity research team published forecasts predicting silver would average 36 to 38 $8 per ounce for the year. This was documented in their client research notes. It was conservative. It was in line with other major bank forecasts. Citigroup had similar projections. The institutional consensus was for range-bound silver prices with modest upside. And then, according to market data, something extraordinary happened. Silver rallied 147% in 2025. According to Gold Silver, Com's analysis, the metal opened the year around $29 and ended the year above $72 per ounce. Multiple sources documented this as one of the largest single-year gains in silver's modern price history. Let's do the math on what this means for a position of 750 million ounces. At $29 per ounce in January, that position was worth approximately $21.75 billion. At $72 per ounce by year end, it was worth approximately $54 billion. That's over $32 billion in unrealized gains in 1 year, all documented by simple price movement applied to the reported position size. Now, here's the pattern that's observable in public data. JP Morgan's research analysts published forecasts of $36 per ounce. That's documented. Meanwhile, according to reports from multiple precious metals news sources, JP Morgan was adding 21 million ounces of physical silver during this same period. Their public research said one thing. Their documented trading activity showed something different. Whether this represents a disconnect between research and trading divisions or something else, we can observe the contradiction in the public record. Why did silver rally so hard in 2025? There are 3 documented factors, and the data supporting each is verifiable. First, industrial demand hit record levels. According to the Silver Institute's World Silver Survey, industrial applications consumed over 25% of annual global supply, with solar panel manufacturing alone driving unprecedented demand. Electric vehicles increased their per-unit silver content. 5G infrastructure build-out accelerated. These are documented industrial trends supported by manufacturer data. Second, monetary conditions favored hard assets. According to Federal Reserve data, years of monetary expansion created an environment where investors sought inflation hedges. Gold hit new all-time highs. According to the World Gold Council, central bank buying reached record levels. Silver, which often moves with gold but more volatilely, eventually participated in this rally. The gold to silver ratio, which had been above 90-1, compressed toward 30-1 by year end, according to market data. When that ratio compresses, silver typically moves dramatically. Third, and this is particularly significant, China announced export restrictions on silver. On November 1st, 2025, according to news reports, China implemented restrictions on refined silver exports, citing national security and industrial needs. While China produces about 12% of global mined silver, according to USGS data, They refine a much larger percentage of the world's silver supply. When these restrictions were announced, according to market reports, the Western physical silver market experienced strain. According to reports from January 2026, spreads between physical silver in different markets widened dramatically. Some sources reported Japanese silver trading at premiums exceeding $50 per ounce over Western exchange prices. These spreads, documented in dealer quotes and market reports, indicated physical shortage conditions rather than normal market functioning. And who benefits most from a physical silver shortage? The entity holding the largest stockpile of physical silver in private hands. That's documented as JP Morgan with 750 million ounces. Let's put this number in context using publicly available data. According to COMEX warehouse reports, the entire registered inventory available for immediate delivery is approximately 45 million ounces. JP Morgan's reported holdings of 750 million ounces represents more than 16 times the entire COMEX registered stock. Some analysts, including AU Bullion Canada, put the ratio even higher when accounting for inventory fluctuations. In theory, according to these numbers, JP Morgan could satisfy every delivery demand on the COMEX for months and still retain the vast majority of their position. But it's not just physical holdings. According to AI Invest's analysis published in December 2025, JP Morgan controls approximately 40% of COMEX silver futures contracts. That's positioning data derived from publicly available commitment of traders' reports and market analysis. To put this in historical context, the Hunt brothers in 1980 attempted to corner the silver market with approximately 100 million ounces and controlled roughly 50% of futures contracts. Regulators stepped in, changed the rules, and broke their position. JP Morgan, according to current estimates, holds 750 million ounces and 40% of futures. The concentration is historically extreme by any measure. Here's the documented mathematics. Every dollar that silver rises in price, JP Morgan's position gains $750 million in value. That's not speculation, that's simple multiplication. 750 million ounces times $1 equals 750 million. According to the rally from $29 to $72, that's a $43 move. Multiply $43 times 750 million ounces, and you get 25 billion in unrealized gains. For context, that's larger than the GDP of more than 100 countries, according to World Bank data. According to Pareto Investors reporting in January 2026, JP Morgan is actively taking delivery of physical silver from COMEX futures contracts. The report states that in January alone, over 1,000 contracts went to actual delivery, with thousands more month to date. Typically, according to COMEX data, less than 5% of futures contracts result in physical delivery. Most are cash settled or rolled forward. But according to these reports, JP Morgan is taking delivery, removing silver from exchange inventories. Every ounce they remove makes remaining supply tighter, which, according to basic economics, tends to support higher prices, which makes their existing position more valuable. Now let's address the obvious question. Is any of this illegal? The answer requires separating different time periods and different activities. And what JP Morgan did from 2008 to 2016, the spoofing, was definitively illegal. They were prosecuted. They paid the largest commodities fine in CFTC history. People went to prison. That's settled legal fact. But accumulating physical silver? That's legal. Closing a short position? That's legal. Taking delivery of futures contracts you legitimately own? That's legal. Holding a large percentage of a commodity's physical supply? That's technically legal, provided you're not engaging in manipulation. But here's the gray area that legal experts debate. If you control 750 million ounces of physical and 40% of futures contracts, and you exercise your legal right to take maximum delivery, are you manipulating the market? Or are you simply exercising your contractual rights as a market participant? The CFTC has position limits designed to prevent concentration in futures markets. But according to regulatory structure, those limits apply to futures and options contracts, not to physical holdings in private vaults. And according to public data, JP Morgan isn't violating position limits in the futures market. They're holding physical metal which isn't subject to the same restrictions. It's market influence through legal ownership rather than illegal manipulation. And that distinction matters legally, even if the market impact is similar. Let me walk through 3 possible scenarios for what happens next. These aren't predictions. They're frameworks based on historical precedent and current market structure. Scenario 1. Silver continues its rally into 2026 and beyond. China's export restrictions remain in place or expand. Industrial demand from solar, EVs, and technology continues growing at current rates. Investment demand remains strong as monetary conditions stay favorable for hard assets. Under these conditions, silver could reach $100, then $150 per ounce over the next few years. JP Morgan's position would be worth $75 billion at $100 and $112.5 billion at $150. If they slowly liquidate into strength over 5 years, they could realize gains exceeding $80 billion from their physical position. That would represent one of the most profitable commodity trades in history. This scenario assumes no regulatory intervention and continued supply constraints. Scenario 2, regulators intervene. The CFTC or other authorities determine that JP Morgan's concentration of physical silver creates market manipulation concerns. They could attempt to impose position limits on physical holdings similar to those on futures. But here's the problem documented in historical precedent. When regulators moved against the Hunt brothers in 1980, the Hunts were primarily concentrated in futures contracts, which regulators clearly controlled. JP Morgan's position is overwhelmingly physical metal in private vaults. The regulatory authority to force liquidation of privately held physical commodities is less clear. Additionally, JP Morgan isn't just a commodity trader. They're a primary dealer in U.S. Treasury markets. They provide critical liquidity for government financing. They're designated as systemically important by regulators. Forcing a fire sale of their silver position could create broader financial instability that regulators might be unwilling to risk. The regulatory path here is unclear and potentially constrained by JP Morgan's systemic importance. Scenario 3, and this is the most speculative. JP Morgan's silver position becomes relevant in broader geopolitical and industrial competition. Consider what's documented. China restricted silver exports citing national security. Russia is a major palladium producer and has used commodity flows as geopolitical leverage. Rare earth elements are critical for defense and technology and are concentrated in a few nations. Silver is essential for modern electronics, solar panels, 5G infrastructure, and military applications. Whoever controls physical supplies of strategic industrial commodities has leverage. If the next phase of great power competition is fought through commodity supply chains rather than just through military force, being the largest private holder of a strategic industrial metal becomes a form of geopolitical insurance. Whether this was part of JP Morgan's calculus, we can't know. But the position they've built gives them optionality that few other private entities possess. Now let's step back. Why does this documented sequence of events matter? Because it reveals how sophisticated financial institutions operate over long time horizons. Look at the documented timeline. JP Morgan began accumulating silver in 2012 according to warehouse data. It's now 2026, that's 14 years. Most retail investors struggle to hold positions for 14 months. But that time horizon differential is exactly how institutional advantage works. Institutions plan in decades, retail reacts in days. Look at the documented pattern. From 2008 to 2016, spoofing occurred and was later prosecuted. During the same period, physical accumulation occurred at low prices. In 2020, the $920 million fine was paid. 2 traders served prison time. And by 2025, according to positioning data, JP Morgan flipped from net short to net long with 750 million ounces of physical. They closed their shorts at what market analysts estimate were favorable prices during the early 2025 rally, then continued buying physical even as prices rose. The fine was $920 million. The position, at current prices, is worth over $54 billion. Using the accumulation price ranges documented in market reports, if the average cost basis was $17 to $20 per ounce, the total cost was approximately $12.75 to $15 billion. At $72 per ounce, the unrealized profit is $39 to $41.25 billion. The return on investment, even accounting for the fine, exceeds 200%, and the position continues to grow in value with every dollar silver rises. Here's what we can document. JP Morgan paid the largest commodities manipulation fine in history for suppressing silver prices. During the period of suppression, they accumulated the largest private silver stockpile in history. They closed their short position right before the biggest silver rally in modern times. Their analysts predicted $36 while their traders accumulated more metal during the rally. And now they control an estimated 40% of COMEX futures and 16 times the COMEX registered inventory in physical holdings. Whether this was a coordinated long-term strategy or a series of separate opportunistic decisions, we can't prove from public records. What we can document is the timeline, the position sizes, the price movements, and the profit. The pattern is visible in public data. The questions about intent and coordination remain in the realm of speculation. But here's what isn't speculation. This is how the game is played at the institutional level. The fine isn't the punishment when the profits exceed it by 40 times. Regulatory penalties become a cost of business when the underlying position generates tens of billions in gains. Public forecasts from research divisions can contradict private actions from trading divisions. Position disclosure rules apply to some instruments, but not others. And time horizons measured in decades allow for accumulation strategies that retail investors could never execute. JP Morgan didn't steal this silver. According to all public records, they bought it. They bought it at prices that were low, partly because the paper market, where they were later convicted of spoofing, was suppressed. They held it while paying the largest commodities fine in history. They closed their shorts right before a 147% rally. And now they sit on what market analysts estimate is a $40 to $54 billion position in a commodity experiencing physical shortages. Every piece of this story is documented in public filings, federal court records, CFTC reports, COMEX warehouse data, and market analysis from credible sources. The crime was prosecuted. The accumulation was visible. The rally is documented. The position size is estimated from multiple independent sources. The only thing we can't document is intent. We can't prove whether this was planned from the beginning or whether different divisions of the bank made separate decisions that happened to align into an incredibly profitable sequence. What we can say with certainty is this. From 2008 to 2026, JP Morgan went from manipulating silver down for 8 years to paying $920 million in fines and sending 2 traders to prison to holding 750 million ounces worth tens of billions of dollars. The documented facts speak for themselves. The interpretation of those facts is something each person has to decide.